Hi everyone, I'm Paul and welcome to episode 12 of my vlog on building a trading system. If you've been watching my channel for a while, then you know that I've been focusing on using ICT's concepts in the London Open or the London Kill Zone, trading both Bitcoin and the S&P 500. I've been refining this model for some time and I feel like I'm starting to get close to what that end product is going to look like. There's still some back testing and forward testing to be done, but what I'm going to do in today's video is break down the concepts behind the trading system that I've built and also go through my end-to-end process from my top-down analysis to execution and trade management. This particular trade on the Micro E-mini netted a 3.7R return, which is a really great result. But as you'll see, things don't always go to plan, especially when you're trading at home with family distractions. So if you're struggling to apply ICT's concepts to your own trading system, or if you're looking for ways to trade the London Open or the London Kill Zone, then this video is for you. But before we jump into today's video, there's something that you need to know. I work really hard at putting these videos together and I know that they provide a lot of value, but you need to understand that these videos aren't free. Now the great news is that you don't have to pay with any money. All you have to do is subscribe to my channel if you haven't already and give this video a like. That's it. Let's call this our gentleman's agreement or our lady's understanding. This is our social contract. I can't look over your shoulder and make sure that you're doing it, so I just have to trust that you will. So in exchange, I'll keep making high quality videos that deliver lots of value, and all you have to do is keep liking and subscribing, which sounds like a pretty good deal to me. And besides, everyone else is doing it, so you should too. Lastly, if you'd like to hear more from me and join a community of like-minded traders, then make sure you check out the link in the description where you can subscribe to my free weekly newsletter and to join our Discord. Now that that's out of the way, let's jump into today's video. So we're looking at our chart on the Micro E-mini from the 11th of April. Now I'll just start off by just going through the execution. So this is basically where my little problem started. I was interrupted with family matters whilst I was placing this trade. I accidentally keyed it all up and then put it in as a sell rather than a buy. So pretty silly, but that's what happens sometimes when you're distracted. So I had to wait a little bit. I was trying to obviously get back out at even. That didn't quite happen. So I ended up giving up about 2 ticks. So you can see I sold 26 contracts, obviously meant to buy. So I just straight reversed that position. I didn't quite get in where I wanted to, but you can see my entry here is at 41.40.25. And you can see I had my first partial here for 13 contracts at 41.43.75. So about 3.5 handles for that first trade. And then the balance was at 41.48. So that's about 7 3/4 handles there. So a pretty neat little trade. I'll go through why I chose those exits later, but that just explains where those entries were, what the little problem was in terms of the entry. Obviously it all worked out fine, but that's sometimes the challenge of trading with family distractions. So we'll start off with our daily chart on the S&P, and this is obviously where I start to do my analysis in terms of what my daily bias is. So if we just zoom out, you can see I have my dealing range from this swing low to this swing high charted out, and we're obviously sitting in a premium at the moment. You can see the market, after taking out the buy side liquidity here, we've traded back down towards equilibrium. We've traded into this order block just here, and you can see the market has then traded higher. We've taken out this buy side liquidity, these relative equal highs just here. We've just traded back into this bullish fair value gap just here, and you can see the market sort of traded a little bit thinly. So this is just after the Easter long weekend and we're coming into CPI data, so the market's sort of a little bit uncertain, if you like. And so looking at this, I can see we've got this external range liquidity up here, and we've got a volume imbalance which has been sitting up here for quite a while. And so what I'm hypothesizing I think will happen is I'm expecting price to trade up above these highs here. So this is the previous week high just here. I'm expecting us to trade up above that and then potentially push up above this buy side liquidity. So taking out that external range liquidity, filling in this volume imbalance before trading lower. So that's sort of what I'm expecting. So going into the session or going into this week, I have a bullish bias. So I've zoomed into my 4-hour chart now, and this is where I start to frame out my trade based on the bias that I've determined from my daily chart. So remember, looking at my 4-hour chart, I have a bullish bias, so I'm expecting higher prices. So again, I've marked out my dealing range on the 4-hour chart, and what I can see from this, we've obviously traded back down out of a discount. We've come into a premium, so we're just above equilibrium. There's a bearish order block sitting at the top of the range, and you can see just on the equilibrium, we've created this bullish fair value gap just here. So what I'm expecting as we come into London, so we come out of that Asian trading range, so we'll have a consolidation in that period. We'll then push down into this bullish fair value gap just down here. And then after that, so that's our Judah swing, and then we'll trade back up into this premium part of the range and into this order block. So taking out this buy side liquidity and trading into this bearish order block up here. So that's basically how our power of 3 should work. So if we're expecting a up day, so we're expecting higher prices, then what we'd expect is our accumulation in the Asian trading range. We'd expect our manipulation, so our Judah swing lower as we go into London, and then our manipulation higher. So that's the basis of my whole system in trading London, is using the midnight open as my way of gauging the Judah swing, obviously in concert with that Asian trading range, and then looking to trade the subsequent distribution after that manipulation. So we're looking at our 1-hour chart now, and there's really not that much more to add now that we've zoomed in, but we can start to see our trade or our potential trade a little bit more clearly. So this was our order block from that 4-hour chart. This was that bullish fair value gap from the 4-hour chart. And if you look, we've got our Asian range, which is formed just here. And below that is where our bullish fair value gap is. And you can see on this hourly chart, we also have a bullish fair value gap as well. And that's our consequent encroachment just there at that 50% level. So again, what we're expecting is we're expecting a break lower out of that Asian trading range as we come into London. So that's our Judah swing, and what I'm hoping will happen is we'll get a push right down into this fair value gap, and I'd be looking at the consequent encroachment as my ideal sort of entry level, and then a pushback, and then I'd probably be looking at taking partial profits around the midnight open, and then potentially the balance off at the top of that Asian range. So that's just going to depend on what happens as we go into the London kill zone, but that's basically the framing of my trade. I'm looking at utilizing that concept of the power of 3 and the Judah swing. So I've got my accumulation happening in the Asian range, and as we come into London, I'm looking at my manipulation down into, this PD array, so into this bullish fair value gap, and then targeting the buy side liquidity up here as that draw on liquidity, which is where I'm going to be planning on taking my exits, or at least using that as the fuel for my exits along the way. So I'm on my 15-minute chart now, and I've still got a little bit of work to do before we go into the London Open, just in terms of refining where I think my entries will be and where my exits potentially will be. So you can see I've just turned on this indicator which gives me the new week opening gap. So these are what these little channels are in purple, and you can see this is the most recent new week opening gap just here, and you can see that's created a lot of consolidation as prices just bounced along that. So I'm obviously looking more closely at this Asian range, so I'm looking at the high and the low of that range, and what I've done is I've run a fib from the high of that to the low, and then I've just cast the standard deviations down. So you can see from this fib and some of the standard deviations off that is that they're confluent already with some of the things that we've marked up on our chart. So if I look below, so remember this is where we're looking for price to trade into. We've got our bullish fair value gap from the 4-hour chart, and we've got this confluent bullish fair value gap, which is both from the hourly and the 15-minute chart. And you can see how neatly that just sits between this 0.5 and 1 standard deviation marker. And then up here where we have our buy side liquidity, and then our order block from the 4-hour chart, which is, remember, where our draw of liquidity is, you can see that lines up quite neatly with this 1.5 standard deviation marker just up here. So I'm going to use these as part of my entry and exit. So I'm ideally looking looking for price to come down into this zone. I've got a lot of confluence there. I think that we'll see the market reverse quite strongly from that point. And ideally, I'm looking for a trade back up into this 1.5 level here. Again, we've got a lot of confluence here with our buy side liquidity residing and our order block. And so I think that will provide a strong draw on liquidity. So we've zoomed right down to our 2-minute chart now, and we're looking at the execution that I actually took on this trade. I've just skipped the market forward just because there was a lot of, back and forth in this session prior to the actual execution happening. But I'll just quickly orientate us on the chart so we know where we are. So this is our Asian trading range. We have our midnight open extended out. Now, obviously, from what I talked about earlier, what I'm looking for is for a trade down lower. And if I just zoom out, you can see that's our bullish fair value gap that I was expecting or anticipating price to trade down into. Now you can see that that didn't actually happen. So prior to the London Open actually starting here at 2 o'clock, you can see the market traded right down to the low of that Asian range. But you can see how we've just gravitated around this new week opening gap pretty much all of the session, even throughout the Asian trading range. So we traded almost back to the top of the Asian trading range before coming lower. You can see we create almost like relative equal lows here, and then we finally take those lows out again. So this is where I started to get interested, and I just really didn't think at this point that we were going to trade lower, but I wanted to wait for a better confirmation. I didn't want to jump in. I knew that there was still a chance that we could trade lower, but I wanted to see, a higher probability setup before going into the market, and that's exactly what we got here. So I'll just zoom into this particular area now and just outline what I was seeing. So we're below the midnight open. So we had our sort of mini Judah swing already happening. It wasn't quite as big as I anticipated, but we still were below the midnight open nonetheless. So you can see we have a low here and then a higher low here. And so this is actually the setup for our mitigation block. So this is our up close candle here, which is at the short-term high in between the higher lows. And if I just extend that out in time in that green box, you can see that here. So in the process of then making this higher low here, you can see the market has then started to trade higher. So we're working on that premise that we've had traders get trapped here, expecting the market to go lower. The market's traded higher, we get displacement, and we have our change of character, our market structure shift here. And we also get a bullish fair value gap start to be formed just here. So we have confluence between our bullish mitigation block, and we also have our bullish fair value gap forming here. So this is precisely where I intended to go long here. I accidentally went short, obviously, and then I had to wait for the market to come back into this zone before reversing that whole trade. But ideally what would have happened is I would have gone long at the low of this particular candle, so I would have had all that confluence built here. And in terms of my exits, I've just got those marked up just here. So I basically had planned to take a partial, so that low-hanging fruit as ICT often talks about, and then my final profit or my terminus was going to be up here at that 1.5 standard deviation level. So I was targeting this draw on liquidity and anticipating a run into that bearish order block, but using this 1.5 standard deviation marker as my exit. So you can see we've got our partial here, and then the intent was going to be that once I'd had my partial, so once I'd got that low-hanging fruit, to then roll the stop to break even or slightly better, and then run the balance to that 1.5 standard deviation level. So if we just play that forward, and we'll just see what happens. So you can see we trade right back into that new week opening gap, and you can just see how price just respects this fair value gap and that mitigation block just there. So you can see on this run, we take out the Asian trading range high, and we obviously get our fill here. So we take our first partial here, which was a risk reward of 3. So that's pretty good on that half. So this is where I took 13 contracts off here, and then I just let the rest run. So I was expecting a little bit of consolidation after this. So you can see just after that little bit of consolidation, the market shot upwards. We took out this buy side liquidity here. So that was an old high, and that propelled us up into that bearish order block. exactly as I anticipated, and obviously my limit was then hit at this 1.5 standard deviation level along the way. So overall, that trade netted a 3.75R return, which is obviously quite good, even though I had that small little blip at the beginning. And you can see, even though it didn't turn out exactly as I expected, I was obviously anticipating a deeper due swing into that fair value gap before running into the order block. You can see the benefit of framing out your trade in advance, and so you already know pretty much what you're going to be doing and what you're expecting. I just had to make a slight modification on that, and it obviously still turned out really well in terms of what I'd planned. Thanks for watching episode 12 of my vlog on building a trading system. I hope you found it helpful, and I hope it gave you some inspiration for your trading system if you're looking to build one. Don't forget our gentleman's agreement or our lady's understanding. I've done my part, and now it's your turn. Lastly, if you'd like to hear more from me and join a community of like-minded traders, then make sure you check out the link in the description where you can subscribe to my free weekly newsletter and to join our Discord. Thanks for watching, and I hope to see you next time.